Saurabh Mukherjea, good morning. Thank you for joining us. All right, lots of things to start with. We can start with the block deal as to what is the future for insurance companies. We can talk about geopolitical tensions, or we can talk about a multi-bagger idea from your side. So I'm giving you the options. You can choose. Okay, there's Saurabh Mukherjea start with the remote in his hand.
So look, I think let's get geopolitical tension out of the way. So let's get the geopolitical tension addressed. Obviously, what's happening in the border is far more serious than my portfolio or most other people's portfolios. Excuse me. So the enormity of the events in the border is far greater than our portfolios. But that being said, the history of our market shows that given the size of our economy, we're a $3 trillion economy now. Even if matters were to escalate, and let's hope they don't, but even if matters were to escalate, the financial hit to the Indian economy is very tractable. It's the world's sixth largest economy now, and even amid conflict the scale of Kargil, the financial hit can be dealt with. Obviously, the human cost is on a different level, and I think that's why the market is relatively sanguine about the serious matters taking place up north, and let's hope the market stays sanguine, and let's hope that matters de-escalate. The Korea America matter has been brewing for several years now. I think the global financial market has learned to live with it, and China America tensions, if anything, seem to be settling down, receding somewhat. So the geopolitics, I would say, is not something we should have foremost in our minds. It's very interesting to talk about, but I'm not so sure how relevant it is to your and my portfolios.
Okay, so you have painted a picture of all that has been going on, and yes, fingers crossed that we do continue this sort of a measured performance for the markets. But you also mentioned, Saurabh, that there's a disconnect between the opportunities and the earnings expansion. Could you explain that?
I think it's been a good 10 years now. If you see nominal GDP growth in India, it's been around 12-13% over the last decade or so. And in only one out of the last 10 years, if I remember correctly, in one out of the last 10 years has the Nifty's earnings growth been commensurate to India's GDP growth, right? And the overall Nifty earnings growth has been miserable for 5-6 years. My reckoning is this is not going to go away easily. It's not a question of suddenly the Nifty recovering 1 year. I think what's increasingly happening as we become more affluent, a bigger part of our consumption pie is coming from imported goods. That's at the B2C level. At the B2B level, increasing spend on capital goods is imported robots, automation, mechanization lines. So the stock market as a play on the Indian economy, the Indian stock market as a play on the Indian economy, unfortunately, is becoming that link is getting broken. Our economic growth no longer seems to feed into stock market performance, which means that stock picking, building an intelligently constructed portfolio in India, I think is becoming ever more important. There is no obvious link anymore between the Indian economy and the Indian stock market, and that really puts the onus on folks like us to stock pick intelligently for our clients.
Could telecom turn out to be that contra bet? I know Jio has really set the cat amongst the pigeons, has been calling the shots in the pricing, and it's almost a war out there with the incumbents. But now it seems that Bharti has really been upping its game. We know that an Africa listing is in the pipeline. Just this morning, there's news about a sizable fundraising that they're looking at. Does it seem like, at least some metal or some power is coming back to the incumbents too?
I think sectors in India which have heavy regulatory construct around it, sectors which have a heavy regulatory construct, generating high earnings growth has always been a challenge for such sectors. It's not just telecom, take power, take infrastructure, real estate. Wherever a sector is surrounded by regulation, the regulators basically suck the profits out. In telecom's case, it's done through initially used to be done through the auctions, now it's done through rule changes. So I'm not as optimistic about sectors like that. If you ask me, the best chance the Indian market has of finding sectors which consistently give earnings growth better than GDP growth are sectors where there is low regulatory intervention, capital intensity is light, so light industrials, the traditional FMCG consumption type plays, IT, pharma. So my reckoning is we're very much in a phase over the next 1 to 2 years where consumption-oriented light industrials, export-oriented IT, pharma type plays will have a decent run. Capital intensity is light in these sectors. The currency is weak. I think the currency is likely to weaken further over the next 12 months. I think that those sectors give us the best chance of generating EPS growth ahead of GDP growth of say 11-12%. The only other area I can think of is private sector banks. As the NBFCs and housing finance companies lose market share on the cost of what's happening in the given what's happening in the wholesale market, as NBFCs and housing finance companies lose market share, the top 4 or 5 private sector banks should be able to pull away from the rest of the PFSI pack.
We are talking about elections, and we'll talk about elections, and the closer we go to the date, everybody will have a view on elections. But from a market standpoint, do you think this is just conversation narrative and nothing more, nothing less? When election verdicts have been on expected lines, markets have moved. When election verdicts have not been on expected lines, markets have come down and then moved. Eventually what matters is the earnings.
Yes, I think the Indian stock market's track record in elections isn't great. It's probably as bad as the opinion pollsters' track record in elections. So 2004, when the UPA won, the stock market I think went circuit down, and then it had the best bull run ever in the next 5 years. 2009, when the UPA when the UPA won again, the stock market thought it was a good result, and then we had a miserable run for the next 5 years. So the Indian stock market's ability to read political outcomes even after the election is done is, I think, fairly patchy, and hence my reading is best to ignore it from a portfolio perspective. Obviously, it's a big human interest story. To see powerful people jockeying for great power is always fascinating, but I'm not so sure it'll make me wiser and wealthier if I obsess about who will win the election. Part of the reason for all this, I think, is there's no great ideological difference when it comes to economic policy. It's not as if our politicians are sitting up late either reading Karl Marx or Adam Smith and losing sleep on matters of economic theory and economic philosophy. Their job is somewhat different in the Indian context. We leave them to do their jobs. We do ours, which is to buy well-run companies who generate good cash flows consistently.
Driving the conviction when it comes to the pharma space as a whole? Do you believe that there are select opportunities within the rest of the basket which they have been plagued with worries of the US FDA concerns, etc.? There are expensive valuations as well. What exactly is driving your conviction here?
So look, I think let's be clear. Sectors like IT and pharma, they don't have companies in those sectors, which are say akin to an Asian Paints or an HDFC Bank. An HDFC Bank and Asian Paints, there is a core. These firms have core competitive advantages that say none of the IT or pharma sector companies have. Those two sectors are far more commoditized. They are competing in a global market with low differentiation in their products, and that's why a currency tailwind is immensely helpful for them. So the rupee going from 63 to 71, I reckon the rupee will go towards 75 over the next 12 months. The rupee sliding in to that extent gives sectors like IT and pharma, which are inherently commoditized sectors, it gives them a real kicker. We've seen the IT companies benefit from that, not just in terms of earnings, but also in stock prices. I think you can see in pharma's Q3 results, the currency benefits coming through. The US numbers are turning around, and whilst the FDA issues will, I'm sure, carry on, it's also clear that the leading pharma companies are getting a better grip on how to deal with the FDA issues. So combination of the currency pulling back with further currency depreciation, I think, ahead of us, decent Q3 numbers from the pharma companies, and in a way the worst of the FDA issues behind us, I think my reckoning is there's a good pharma recovery ahead of us over the next 12 months. I said the same about IT 18 months ago, and I'm sticking to my IT call, and I would like to add pharma to that list of currency beneficiaries as we continue to exist in a phase where the rupee is heading downwards.
Tactically though, Saurabh, I mean, I know there are a lot of overhangs for us and there is a lot of uncertainty, but we will overcome that in due course of the time as well. Do you stay with more of the same? Do you continue to buy the quality 4-5 names in the Nifty which have performed in the recent past? Or do you think the time has come to now tactically move yourself and maybe start nibbling into the small mid-cap names or even some of the large caps which have been beaten down?
I think I remember doing a show for you guys around Diwali where I mentioned that the way I think about portfolio construction is I have a sort of core in my portfolio, say 10 to 11 stocks, which are what I call structural compounders, well-run companies with core competitive advantages, clean accounting, good corporate governance, so the Asian Paints, HDFC Bank type plays. These sorts of companies are invariant in my portfolio. I sit with them for very long periods of time, and I will admit that I personally own these stocks. And then around another 8-9 stocks, I take a tactical view. So for example, my tactical view is that the housing finance companies and NBFCs will cede market share rapidly to the private sector banks. So I'll add a couple of other private sector banks to my portfolio. They might not be of the quality of HDFC Bank, but they will be able to benefit as well from the shift in market share from NBFCs to housing finance companies. Similarly, I'm not saying IT and Pharma are structural bets for me, but given the extent of the rupee weakness, I think IT and Pharma companies will tactically perform for me over the next 1 to 2 years, and therefore I'll have a couple of stocks from each of those sectors in my portfolio. So I try to blend the two, majority of the portfolio, perhaps a little more than majority of the portfolio in structural plays, and then something like 40-45% of my portfolio on tactical plays. Obviously, all of these companies have to have clean accounts. If the accounts are not believable, then I'm just whistling in the wind. But leaving that aside, I think on the tactical play front, there are opportunities in private banks, there are opportunities in IT and Pharma. Small ticket consumption, which doesn't require borrowing money, is in good shape in our country. We're seeing that for the last 3 sets of results. I think consumption will continue roaring ahead. The recent budget that the FM announced is very pro-consumer. So there's plenty to play for. It's not just large caps. There are some mid-cap plays, 1 or 2 small cap plays as well. But the primary focus, I think, has to be underlying quality in the financial statements, strength in the franchise, consistently good ROCs. I think without that, you really find it very difficult to make money in India.
Saurabh, I just want to go back to those classic compounders, and I just had a chance of watching a Harvard Mark Google talk, and he said, look, if you bought the classic blue chip stocks in 1960s, which is GE, Kodak, 3M, I mean the 1960 classics, you did not make money because those were fully priced. So my only fear with these classic compounders is that their businesses will continue to grow, but in today's market, are they pricing in next 3, 4, 5 years of growth? They may not give you even market beating returns for next 3 or 5 years. Is that the risk for some of the A quality great mod franchises like Asian Paints or an HDFC Bank?
So I think one fundamental difference between American investing and Indian investing is exactly this subject, and that's the reason actually I write books in India. In America, you will not find it possible to find a company. You will not find in America companies which have return on capital massively above their cost of capital for decades on an end. You won't find companies like Asian Paints, Britannia, ITC, HDFC Bank, Marico in America. So American firms that we are all familiar with, say Walmart or JP Morgan. These sorts of companies have return on capital pretty close to their cost of capital because America is a far more competitive economy. Ours is the only large economy in the world where companies continue to dominate sectors for decades on an end, and B, they have return on capital well above the cost of capital. So I'm sure Howard Marks is right in the American context, but that message does not apply to India because unfortunately or fortunately, whichever way you look at it, an Asian Paints or a Britannia is able to maintain return on capital way above the cost of capital for decades on an end. And that's why the company, I think Asian Paints' case, they're up 1600x since their IPO in 1983. And 1600x in a pretty smooth line. It's not as if Asian Paints had a good run and then suddenly it stagnated. I reckon that continues. I'm not saying this is true for lots of Indian companies. I would say barely 1% of Indian companies fall in the category of Asian Paints. On 99% of Indian companies, Howard Marks is absolutely right. But there is 1% of Indian companies the structural compounders, the classic compounders, there is this 1% which are able to continue dominating their sectors for decades on end in a way which is not possible in the United States. And as a result, these companies give you 10x in 10 years, 100x in 20 years, 1000x in 30 years. It's a shame to not have those companies in your portfolio. It's like an ATM machine. You stand in front of it and collect the 2000 rupee notes.
That's a great example. It's an ATM machine. My challenge is, sort of on a lighter note, I've started using Paytm much more. All right.
I understand. I'm sure that will make money as well one day.
All right. I appreciate your time. Thank you for joining us.